Okay, so Charles is going to stay up on stage now as we have our VC panel run by my good friend and fellow LendIt co-founder, Bo Bruskern.
Hi. Oh. Thanks everyone for joining. I'm really looking forward to this panel, and I know the audiences as well. This is always much anticipated. So thank you for joining and taking the time. Hello everyone, my name is Bo Bruskern, and I am one of the co-founders of the LendIt Conference and a partner at Lend Academy Investments. I think it's probably best if I just hand the mic over to the four of you, so you can introduce yourselves. All of my friends here on the panel are venture capitalists active in the space, and we've chosen them specifically because of their depth of expertise in the area. Charles, you've made quite an introduction of yourself. Is there anything else that you'd like to add?
No, I would rather give time to these guys. Yeah.
Great, Alex.
So, Alex Proher from Skagit Investments. Skagit Investments is a private investment company with offices in New York and Eastern Europe. We are big believers, evangelists of peer-to-peer. We've done a number of things in North America, in China, and we have a Eastern European peer-to-peer in our portfolio. We look at things both on the equity and the debt sides, and our primary focus is fintech investments.
Frank?
Frank Rotman, founding partner, QED Investors. So Charles so kindly said they're very active in this space. Well, our backgrounds are from Capital One and helping to build consumer finance companies over 25 years, and in the venture business now for 6 years. We've invested in probably 8 to 12 platforms in the space covering most of the major asset classes that range from student lending to the traditional peer-to-peer consumer loans, to small business lending. So most of the asset classes out there we have something to do with in building an origination platform or investing in an asset lender. QED Investors specializes in financial service fintech, and we also have a pretty active practice in marketing service and ad tech.
I'm Nick Shalick from Ribbit Capital. We're a venture fund based in Palo Alto and focused entirely on the financial services space. We invest in entrepreneurs and companies who are doing innovative things and in changing the way consumers and small businesses experience financial services, and lending is a very big part of that. So we're investors in, amongst others, some of the companies that are here, including Capital Access Network, Borrow, Funding Circle, and some others.
Thank you. Thank you for being here. Frank, 3 years ago, this industry was a blip on the screen. 2 years ago, we didn't even have an industry conference. Last year at our inaugural conference, you said that the banks are not even aware of Lending Club. The term is foreign to them. They haven't heard of Mint. Has that changed? What's going on in the industry today? Bring us up to date.
Yeah, so the short answer is no. It actually hasn't changed. So we still spend a lot of time with the C-suites of the banks and spend a lot of time figuring out if the banking community is aware of what's happening in this industry. And it's really more of the same. It's a little bit different in that they're aware of some of the names now, but they don't quite understand the competitive threat. They don't understand what's actually happening. So a good example, we talked to one of the top 5 banks in the country about their installment loan business, which was shut down in the 2008-2009 period. We said, are you going to be restarting this? I mean, it seems like there's a lot of activity in personal consumer loans and debt consolidation loans. And the answer was staggering. They said, yes, we are going to be restarting this, but it's just going to be a cross-sell into our existing customers. It's only a couple $2 billion. We're not really worried about some of the players that are out there. We still have our core business. Our customers still like us. We're going to do it because we think we need the product, but we're not going to open it up to new customers at all. And that's really the type of thinking and the type of language that we get when we talk to banks. So they're aware of what's happening, but they don't understand that it's a few $1 billion now, but it's really a trend. It's a very different business model, and it's something the banks need to really pay attention to. But not much has really changed. The banks are still busy fighting regulatory battles, and they're still dealing with capital adequacy. And it's still an environment where the CEOs and the executives at banks, they will not get fired for missing earnings. They will not get fired for their portfolio size is going down. They will get fired for getting in regulatory trouble. So it's a very similar environment to last year, except they're now aware of the names.
So there's name recognition now. Charles, you mentioned that the market is larger than we think. That's a major part of your thesis, that the $1 trillion that gets a lot of people in this room excited.
Yep.
So tell me a little bit about that. You offer the Amazon Walmart analogy. Can you expand on that a little bit?
Yeah, we chatted about this briefly about what will it take for the C-suites of the banks to really wake up, and I draw to an analogy of Walmart and Amazon. So I know some folks on the Walmart board, and I've asked them, why did you not do anything about Amazon early on? And they explained basically that if you are a Walmart general manager of a store in some small town, you have your earnings target, you have your goals, and unless you're feeling the pain and you're seeing your business go away, you're not going to say anything or do anything, and therefore it's not going to bubble up as an issue. And so by the time that store manager feels the pain, the problem is so large, it's just too late to do anything about. And basically Amazon did that to them, and I think the marketplace lenders are going to do that to the big banks. Until some branch manager in Omaha says to his division manager, hey, I'm losing business to marketplace lenders, the big banks, they really won't care. It just won't register for them.
Okay, so change then is led by consumer behavior. The installed base of service providers aren't scared yet, may not be scared for many years. This gives us some air cover, right, to innovate. What's happening with consumer behavior? Does somebody want to jump into that and say what you're seeing that makes you really believe that the time is now, and that this wave this tide will continue to rise for the industry?
I'll just say one thing, which is 4 years ago or so, when Lending Club wasn't as large and successful and profitable as it was, we as a board felt like there was an opportunity for us to make more money off the loans than we were making, right? There was this big spread, and we were taking none of it. And we were pressuring Renault, like, we are leaving all this money on the table. And Renault's position was, no, we're going to be fully transparent to our customers, and we will always be, and that is a fundamental tenet of our business. And to his credit, he wasn't as greedy as we wanted him to be, and I think he proved that he was right and we were wrong. And I think this sense of transparency is a very big deal, that both sides of the equation really can get very comfortable with who's on the other side, and that it's really a legitimate asset class. Mm-hmm. And not just one data point that we've seen. Okay,
and for the others on the panel, there's a proliferation of platforms here. There are many verticals that are appearing here, right? So what gives you the confidence that these verticals will catch hold and catch fire and originate like the Lending Club model, like the Prosper turnaround?
I think in some cases they will, in some cases they won't. There are a lot of talented entrepreneurs who have seen what's happened with Lending Club, with Prosper, with Funding Circle, and others. And what makes it exciting is that brings talented entrepreneurs and technologists into the space, into a space where you used to have to be a bank, you used to have to be a specialty finance company, you maybe needed relationships in securitization markets or on Wall Street, and we're seeing entrepreneurs who don't have that background who are suddenly saying, hey, lending is a place that I can play and it's interesting. That doesn't mean that every lending market will make for an interesting marketplace business. And honestly, a marketplace does not make a business in and of itself. And this is something I'm sure we'll touch on again at different points in this panel. But Lending Club 4X is, I think, not the right way to think about it. Building a new mortgage bank, using all of the technology and data and things we understand about mobile and internet technologies, that's the right way to think about it. Or a new auto lender, as opposed to just the source of capital is just a means to an end, and it's really about building a new brand and new relationships with consumer.
Okay, great. So let's talk a little bit about the proliferation of startups. I know that there has been some discussion about the fact that at last year's conference, the inaugural conference, we had, I'm guessing, maybe 20 platforms present, and now we've counted over 100. What does that number look like next year? gross number. How many of the 100 today will appear next year? And how many of those 100 today will see some sort of positive exit? And how many will have an outlandishly positive exit? Pick an answer. I don't need opinions on every question from everyone, but pick your favorite and fire away.
So Charles likes the number trillion, so I'll throw out trillion platforms out there. But in all seriousness, I mean, the question is a good one. We're seeing 50 or 100 startups in the space. We're talking to quite a few of them, and there are interesting business plans out there. If there's a consumer asset right now, someone has a platform trying to disintermediate whoever the originator is in that category today. So if you name the asset class, there probably are 3 or 4 startups that are out there trying to tackle it. They're trying to understand the incumbents, and they're trying to build a marketplace in a very different way. And what we've seen is this hyper-fragmentation of the value chain, right? And it used to be, we all know this story at this point, but it used to be that in order to make a loan, you had to be a bank and you had to have sources of capital and a bunch of other pieces of the infrastructure, including servicing and including credit underwriting, including data. I mean, there's a lot of things you needed to make a loan. And with the hyper-fragmentation, you can assemble it in any way you want. So each startup is assembling this value chain in a different way. So in auto, you might end up with 5 or 6 startups in the space. One might specialize in channel, one might specialize in the balance sheet, one might specialize in consumer experience. And you're seeing just different assemblages of the businesses out there. And some of them will succeed and some of them won't. And it's going to be a combination of the quality of the entrepreneur and the channels that they're actually chasing. And ultimately the quality of the business that they're trying to build. Because you have to assemble it the right way, but there are a lot of ways of assembling it that are the right way. There's no one answer here.
So when we were evaluating the opportunity to invest in Lending Club a few years ago, the discussion that we had was, is it the winner-take-it-all approach? Is there going to be one Amazon, one eBay of financial service, of marketplace lending, if you will? And I kind of like what Renaud talks about of financial institution of 21st century. So, and one of the thoughts that that we had after discussing with various people is that in the credit market, it's so deep and there's so many different players that likely there will be number of different players out there. So if you look at the landscape today, there's big banks, there's small banks, there's small specialty finance, there's big specialty finance. So some of these platforms will survive. Some of them will have exits. Some of them will die out because you need to have some sort of a critical mass and some sort of a loan volume to pay for your lights. And you might not get to the next round because you might be too small for a VC community to look at and might not tackle the market in the right way. But so I think we'll see a number of scenarios play out here.
Alex, can you keep the mic for a second and talk to me a little bit about, since you're an internationally based fund, you naturally will look at platforms in the domestic United States. You'll also look elsewhere, of course, as many of my other colleagues here will. But when we go, Lend Academy, when we go and talk to overseas platforms, we often hear the phrase, we are going to learn from, or we're actively learning from the path that Lending Club and Prosper took. Talk to me a little bit about that. Are there tangible things, lessons that can be learned from sort of the way that the market is developed here, and vice versa? Can we also can platforms here in the United States learn from what's going on overseas?
Absolutely. I mean, even in our own Eastern European peer-to-peer, we have another investor who is also investors in Zopa. We take a lot of cues not only from the peer-to-peer platforms here, but we also learn from how the ecosystem around it is developing. On the other hand, there's also some interesting things that are happening internationally, for instance, in Asia, in terms of lender acquisition in some of the countries where internet penetration is low, where the trust in the financial system, trust in online is different, specifically in China. You have companies that actually went out and built not only networks, branch networks to originate lenders, but also wealth management network, branch networks to originate, to not only to originate borrowers, but also to originate lenders. There's also some interesting things that are being done on to insure risks, and there's a company here that is owned by Penang to insure risks. Excuse me. So I think that we see interesting things that the government in continental Europe is doing to help small business lenders and providing capital to them, and some interesting things on the remittance using. We were approached specifically by Visa and MasterCard that wants to help us lend money directly to people's credit cards so they can access those funds quicker and easier. So I think there's definitely interesting things that we can all learn across the globe and help this consumer experience better.
That's great. That bodes well for our conference, I guess, if all that is true, and I'm sure it is.
You know, one of the things that I really like about this industry, unlike, let's say, I can look into the SaaS or HRM or cloud industries, is that there's a sense of community. And when you talk and you bring the CEOs of many of these companies together as competitors, they're very collegial, they share with each other, they really are trying to help each other succeed because they know that the whole industry will benefit if they're all successful. And it's a very unique dynamic as far as we're concerned, and it's something that I really appreciate.
I've heard that and repeated it many times at this conference, and I love that that's appreciated, especially from this panel, because that's something that we, as stewards of the industry, really passionately want to protect. I want to take a little bit, what might seem like a little bit of a left turn and dive deep into some technology that I profess I don't understand terribly well, and that is the emergence of Bitcoin. Nick, can you help us understand, does Bitcoin play into this world at all? And if so, can you give us a little kindergarten level understanding of how this is going to play out?
Yes. Yes, I do think Bitcoin matters for peer-to-peer lending, or the marketplace lending world, and the rest of financial services in due time, and it will certainly take some time for it to matter. But probably the way I would suggest thinking about it is as an enabling technology for what the Bitcoin protocol really accomplishes, which is sort of borderless, frictionless transactions, including transactions of some new types that we haven't experienced historically, like very small dollar cross-border payments. So, if you think about what's enabled online commerce, sort of old lending was very geographically constrained, bounded by regulation, a lot of paper offline processes, and what we're seeing from all the online lenders that we're talking about today is using new technologies, web, mobile, API-based data and payments to build user experiences and new brands that hadn't existed in the past. And Bitcoin is really just the next generation of that. And I think it'll, for a more globalized, more borderless world, and I believe this industry will go in the same direction as we'll see other financial services. So. So if you want a glimpse of the future, you can look at BTC Jam, which is a very young company that we invested in, but less than a year old, and has people borrowing and lending in a true marketplace model in 80 countries around the world. That is totally fascinating. And congratulations for taking such a risk. So, and I mean that seriously. I want to hear from each of you sort of a little bit more about the stage of investments, the types of companies you like to see, kind of high level. What risks do you like to take? What risks do you like to see solved before you invest? Charles, you want to head off? Sure.
Had my slides actually worked, one of the things I would have mentioned was that I really don't believe there's a Groupon phenomenon that occurs in this space. Meaning, when Groupon and Living Social really broke out of that category, there were probably somewhere in the neighborhood of multiple thousands of equivalent startups around the world because there were very few barriers to entry. And in this space, you've got regulation and capital and data and some other things that make it very challenging. And so I think you will see a selective number of startups break out. And to break out, those startups need, in my opinion, to find some market inefficiency, some uniqueness that they can hang their hat on, whether it's related to borrower acquisition or data or access to capital or an access to a market that's hard to otherwise find. But there has to be something unique about what it is that they're doing at this point. I think 5 years ago that wasn't true. You could be more generic and succeed. But at this point, you really do need some unique insight.
Okay. Alex?
We're stage agnostic. We don't do necessarily seed investments. At this point, I can only agree with what Charles said. But I think as we look around globally, there's certainly opportunities in various countries where maybe it won't be necessarily one platform that has a single product in line, but that will develop multiple competencies within itself and can address several credit verticals. So I think globally we're optimistic, and I think there's still opportunities.
So we're also stage agnostic, and we actually have funded some companies that were pre-revenue at the seed stage, and we've invested in some companies that are much more mature. And it really comes down to conviction. I mean, coming from operating backgrounds, you know when a business is ready. And having that conviction is around seeing the momentum, understanding the marketplace, like Charles said, understanding the differentiator at this point. I mean, another generic platform saying, I'm better than X, Y, or Z, or I'm the so-and-so of so-and-so. It's a really difficult investment thesis. It needs to be a lot more about something that truly is competitive, whether it's a competitive channel or it's a product that's disrupting a pain point in the marketplace. But to disrupt some of the players that are already here and doing well, they actually have more capital. They have the ability to outspend some of the smaller companies, and it makes it very difficult for them to forge their way in a marketplace that might already be crowded for that business model and that asset class. So it's much more about understanding the operator, understanding the vision, making sure it's a better business model, and again, making sure that they have something that actually makes sense, that a rational consumer or a small business owner would say yes to in a landscape where they have choice.
I think it's that last point. We back the best entrepreneurs when we can find them, and that happens at different stages because we, like Charles, believe this is a trillion-dollar opportunity, use Charles' words. But what we don't fund, I'll sort of put it that way, is we don't fund entrepreneurs who don't know their customer and don't have the beginning, at least the beginning of an idea and the beginning of data saying this is how we're going to find that customer and acquire that customer. Right? It sounds like a very basic point, but I think there's a temptation because there have been successful models in this space, lending clubs and Prospers, to just take that model and try to apply it to something else and create what sounds like a very compelling business plan. But then when you really start to strip away and say, given that this is a new business without a brand, is the customer pain point that you're solving and the way that you're going to get to them, is that a substantial enough problem or innovation that you're going to be able to overcome the sort of inertia? And that really comes down to understanding the customer. So I'd encourage all the entrepreneurs here, especially the earlier stage ones, to think about that and get data on that before they start to try to grow the business.
Perfect.
I will say one
Go
other
ahead,
thing.
please.
I mean, at the end of the day, these are credit businesses. We've kind of glossed over like one of the most important components of building, a business in this space is that credit is like fire. And at the end of the day, if you know how to use it, it can cook food, it can, light your room, it can do all sorts of good things, but it can burn your house down. Right? So these are credit businesses, and a lot of the startups that we see don't have an appreciation because they haven't been through the cycles. I mean, this entire industry has not been through a cycle yet.
Right.
So it's important to understand that at the end of the day, it's not just about, I charge X, I buy a FICO score and it's projecting Y in terms of losses, and therefore there's positive spread, I make money. It's not that easy. And the credit underwriting and the credit technology, the appreciation for credit risk is actually critical in this entire industry.
As we work our way back down in this direction, we're unfortunately running out of time. I would personally love to have this panel go on all day. choose your words, choose your question, advice you'd like to give to an entrepreneur, or what are you dying to see? What innovation are you so hoping that a credible entrepreneur is going to come to you today and say, here's my idea, here's how I'm executing it. Give me those two. Pick your answer there. Come on, these are good questions. Dive in.
No, you said working
sorry.
backwards. I'm waiting for Nick. That's like great.
I'm happy to start. No, for us, look, it's really nothing gimmicky. We look at those giant green circles that Charles put up on that chart, or maybe it was the giant blue circles with the small green.
Right.
What we're looking for are entrepreneurs who come and say, this giant blue circle, this is how these businesses were built over the last 30 years. That's not how we're going to build our business today. We're going to build a technology platform, a data and underwriting model, a way of interacting with our customers and building a brand that's suitable for the world as it exists today. So, and hopefully I'm not repeating myself too much, but what I would say to entrepreneurs in the audience as advice, if I can, is don't build Lending Club for X, build the most interesting lending business you can that's solving customers using technology that's available today, and think about the new channels and either how you're going to build a brand or a channel that will help differentiate you over time. Because in the end, we're talking about credit. We're giving people money. It's a commodity, and I think you need something over time that differentiates you. And for Ribbit, we think about brand a lot. I think there are other ways of building sustainable advantages in acquiring customers.
I'll make it easy. I'm going to agree with Nick.
I would say that focus on niche channels. Try to find channels where you can get a sizable market share and be a kind of a disruptive company. I'd say capitalize on the hype that's in the industry and get some talent, seasoned talent on the credit side or on the technology side that you can actually use sort of the high power or the VC money and get that talent in your team. It would have been much more difficult to do 4 or 5 years ago. So I think that would be my advice.
Yesterday, Scott Riles from Echelon was on a panel, and he talked about supply chain. And I agree, by the way, with everything these guys said. And if you think about supply chain and factoring and receivables, it's definitely a complicated space, but I've never seen a situation where there's one company that people all refer to, which is receivables exchange, as some failure point. And everybody's like, why did they fail? And what can we all learn from that? And how can somebody else succeed? And it is true that receivables exchange clearly didn't succeed to the extent they've wanted to. And it is a huge space. And some set of companies will emerge to untangle that very complex supply chain, I think, because there's a lot of money that moves back and forth between those companies.
Great. Thank you very much for your insights. I'm sure the audience really were delighted with your presence here. And we'll see you again next year.
Great. Thank you.